Welcome to the weekly update, where I'll go over the action in the market for March 6th through the 10th, and then we'll see how things look for the week of March 13th through the 17th. Things have really shifted back over to looking a lot more negative now, especially on Thursday and Friday. We saw a big downturn in the stock market, which is mainly being blamed on this failure of the Silicon Valley Bank, which I'll talk a little bit about throughout this video. Now folks are wondering, is that just an isolated case that will just stay within that particular bank or in that particular region? Or is this the beginning of something bigger? And of course, as always, you can find information on both sides that say, no, we've got things under control. Or others are saying, no, this is just the beginning of something that's going to develop into a lot bigger problem. As far as the technicals, we did turn a lot more negative, especially in the daily charts. We're full-blown negative right now, but we're also oversold in the short term as well as the intermediate term. As I go through the weekly charts, you'll see that things are weakening quite a bit as well, and there's some confirmation between the daily and weekly charts suggesting that we are weaker, but at the same time, we might be at potential support. We'll have to sit back and evaluate this and say, did the market overreact this past week? We have some big economic reports coming out this week, especially CPI. If that comes in better than expected and the market is about at a support level at that time, we could get a nice bounce off of that. If CPI comes in hotter than expected and we're at that support, we could break through that support level. So let's go back and talk about what happened in this week's session. On Monday, there was a waiting game because Fed Chair Powell was going to be testifying before Congress on Tuesday and Wednesday, so the markets were a little apprehensive ahead of that. Then on Tuesday, he did start testifying, but right before that began, they released his prepared remarks, and the market didn't like that at all. They took it as pretty negative. On Wednesday, while Fed Chair Powell was testifying again, there really wasn't a lot of new information there, so the market didn't really have any conviction. News came out that SVB Financial was seeking to raise capital. What was happening in Silicon Valley, a lot of people were saying, uh-oh, this bank is having some trouble. I need to go get my money out. And when you have a lot of people doing that at the same time, that's called a run on the bank, similar to if you ever saw It's a Wonderful Life. What the bank has to do in order to meet those obligations is sell things, usually at a loss because interest rates were so low, and a lot of the assets that this bank owned were well below the current inflation rate. Being backed into a corner, they had to sell those for a loss to give their customers money. When you do that over and over and over, suddenly you have a big problem on your hands. And that then bled over into Friday's session where they ended up shutting down the bank. It was announced that SVB Financial Group's Silicon Valley Bank was to be shut down and that the FDIC would step in to protect the depositors. This produced a situation that we haven't seen on as big of a scale in quite a while. This is called a flight to safety. Stocks, although you can get better returns, they're considered to be riskier, and that's a risk-on type of investment. When the market perceives that there's a lot of risk in the stock market, they'll get out of stocks and jump into bonds, which are perceived as being a lot less risky. That's called a flight to safety, when you're taking money out of one asset and putting it into a different asset that is assumed to be safer. So we saw that a bit during Thursday's session, and then it carried over into Friday's session, and it may carry over into this week. That's why we saw stocks going down as people are selling and bonds going up as people are buying bonds. Typically what we've been watching for lately is bonds and stocks to go up together, because as bonds go up, that lowers interest rates. It's kind of reversing right now, and we'll have to see how long that lasts. We also had the employment situation report that came out on Friday, and it was stronger than expected as far as the number of new jobs, but it was weaker than expected when you look at the average hourly earnings. Initial reaction was positive to the employment situation report because of the slowdown in average hourly earnings. That didn't last very long. Eventually, before the market opened on Friday, we were gapping down lower, and everything combined with the SVB situation just produced a pretty negative climate. After Friday's session, the financial sector declined 8.5% on the week, and I have a chart to show you that. Looking back over the week, we were down 4.55% with the S&P 500. Volume did pick up. It took until Thursday and Friday to do that, and to see an increase in volume on a down day, on one hand, could be discouraging because you see a lot more conviction with people that are selling. On the other hand, it could be positive because people are reacting to what's going on, and that could produce some kind of a washout situation. The technicals are still positive overall with the weekly charts, and we were showing a lot of improvement, but this week did a lot of damage. And that mainly has to do with the inflation and interest rate scenario. But we're also now wondering, is something going to happen in the banking industry group and then the financial sector? Our trend is still weakening and the red line has now gone on top. So we've defaulted to the negative trend, but we're not in a trending environment. We're still seeing that same thing in the daily charts. We're switching over and the trend is getting stronger, but it's still below 20 overall and it's negative. We're starting to see a confirmation of that now in the weekly chart. Here's an intraday chart showing how we did for the week, going way back over here to Monday where we did go up a little bit. Monday ended up being the high. We saw some initial buying coming in that took prices higher, but then we just drifted lower since there wasn't a real lack of conviction. Then on Tuesday, things were pretty much flat, and then the prepared comments came out, and we went boom, down. We ended up going all the way down below S3 that day. Then on Wednesday, didn't really have a lot of conviction here. Really narrow split between the high and the low. On Thursday, we gapped higher, but then spent the entire rest of the day going down, also falling below S3. Then Friday, we gapped lower, tried to fill the gap and go take things positive. We were below the 200-day simple moving average, and then we fell down from there, went down to the 38.50 level, bounced up to S1, but then closed right back down at the low. So we closed pretty much near the low for the day and for the week in Friday's session. So for the week, the Dow was down 4.4%, the Nasdaq down 4.7%, the S&P down 4.5%, and small caps were down 8.1%. Small caps and mid caps had been hanging in there and doing a little bit better. They just got shot this past week. Here's the performance for the week where the Nasdaq 100 actually held up the best, even though it was down. The S&P is the pink area here. Then way over on the right, the small caps and the mid caps, which again had been doing better. Well, when things shifted, they started to do worse than the other indexes. Here's going back to the beginning of the year where the Nasdaq 100 and the Nasdaq are up, followed by small caps and mid caps, still strong even though they gave up a lot of their gains this past week. The S&P is positive, but if you look at the NYSE and the Dow, going back to the beginning of the year, they are now down. This is going back to the all-time high where all of the indexes are negative, with the Dow being down the least, Nasdaq 100 and Nasdaq still being down the most, even though they've tried to repair some of their losses. Looking at the different sectors, all the sectors were down on the week. Shouldn't be a real surprise. The financial sector was down the most at 8.5%, and everything was taken lower. Here's the RRG graph, and I introduced this with last week's video, and this can be a little hard to understand. Just to go through a quick primer on this, remember back to your geometry class, where you have an x-axis, that's the flat line, and the y-axis, that's the one that goes up and down. On the x-axis, when you're to the right of the y-axis, that's positive. When you're to the left, that's negative. Going up and down, when you're above the x-axis with the y-axis, that's positive, and when you're below, that's negative. If you have a minus plus, then you are improving. Here, if you have a plus minus, you're starting to weaken. And then if you have a minus minus, that is the lagging sector. Over here on the side is a key. XLF is the financial sector, and it had been weakening already. The thing that I'm hearing is, oh, I didn't see this coming. This caught the market totally off guard. Well, yeah, but you can still see things under the surface in the market that are developing before they happen. The financials had already been weakening. Well, then they got taken lower. So then this yellow line just continues to show weakness. Even though it's not necessarily lagging yet, it is showing some weakness here. And some of you might find this interesting to just pause and look at this. If you want an updated version of this chart, go to stockcharts.com. It's a free chart that's available to you, and you can just use the defaults and play around with it a little bit to see if this helps you just to understand what's happening with the market. We have communication doing quite well, as well as tech. And these are some good areas for growth where they don't have to necessarily be the leader, but just if they're going up, that could give some good support to the market. Areas that are quite weak now are the utilities, the staples, and healthcare. And these are more value plays right now. That's one thing that we saw over this past week is that value was down more than growth. They were both down, but growth held up better over this past week. We'll be keeping an eye on that. Here are the sectors just for the last 5 trading days, showing that all of them were down, led by financials way over on the right. This goes back to the beginning of the year with you have tech, communication, and discretionary. Those are growth areas. and they're still holding up a little bit better. Energy, healthcare, and utilities, as well as staples, they are down, and these are more value areas. Then going back to the all-time high, we have energy, which is still in the lead, and then all of the other sectors, which continue to be negative. Looking at sentiment, we really dropped. We're down now into the extreme fear camp, where we had been neutral before that. And here's the historical chart, where not so long ago we were extreme positive, especially in Thursday and Friday session. We really dropped as fear started to just massively come back into the market. Here's the VIX showing how it had spiked up. And a lot of this is not necessarily surprising, especially with a little bit of hindsight, where the VIX was low, so it was time to go, but it had been low for quite a while. Well, when things really started to shift, fear just massively jumped back into the market, both on the line chart and on the bar chart. The active asset managers survey, now this is a week old, where they were showing some improvement, but this is based on last week's data. This is probably going to drop significantly in the next survey that comes out. The right X bull bear ratio has folks pretty much in the middle. They tend to react to what's happening in the market instead of proacting, where we're not seeing anything really extreme with the bear bull ratio. Also, another group that tends to react to things saw a little bit of improvement with the individual investors because a week ago was pretty good. This is probably going to drop down to extreme negative again. The Ulcer Index, not really helping us right now. As fear is going up, we're seeing the Ulcer Index drop, and we're seeing that same thing on the daily chart. Looking at the economy, now this is a little bit old. This comes out as of March 10th on older data. This suggests that the spread between risky and non-risky loans is still hanging in there. We're going to be watching this chart very closely to see if that changes. And then the National Conditions Index, this came out as of Wednesday. It's still below this black line and holding up for right now, but we'll be watching this as new information is released. And then this hasn't been updated since the beginning of February. These are the tightening standards for banks, and they're continuing to raise them, which also makes you think, are we going to see more banking problems than what we just experienced this past week? Looking at inflation, we will have CPI coming out pretty much flat across the board here. Hasn't really gone up too much, both with the CPI and with the PCE forecasting. Another thing that's big in the window of what's happening right now is what's the Fed going to be doing? Well, a week ago, as of March 3rd, there was a 71.6% chance that the Fed will raise rates 25 basis points and only a 28% chance that they will raise them 50 basis points. Then on Tuesday, Fed Chair Powell came out and said things the market didn't like. It automatically shifted over to a 72% chance that, no, we're going to get a 50 basis point hike. Then the interesting thing is the market is still pretty much predicting that there'll be a 50 basis point hike at the March 22nd meeting. Now with this banking situation that's come in, people are starting to wonder, is the Fed going to be that radical and raise them 50 basis points, or should they just raise them 25 basis points? Because there might be more banking problems on the horizon, and this could really damage things a lot more, because the old adage is that the Fed keeps raising rates until it breaks something. Is what we saw this past week, is that the break that we could expect, or is there more on the way? Then looking at the Fed balance sheet, you also have them decreasing their assets as they're tapering here. And that's also producing some headwinds for stocks because it's taking liquidity away from the market. Looking at breadth, starting to turn a little more negative based on price and volume. We're dropping below this moving average on the weekly chart. Looking at the advanced decline ratio, still positive, but it is declining overall. And then the new highs, new lows, starting to see a real breakdown in the new lows and not a breakout in the new highs. So our 4-week moving average is declining, and we are declining with our 10-week moving average. Accumulation distribution staying somewhat positive. We're still above this moving average. If we drop below that, that would turn things more negative. Looking at our trend, here's the red line that's now crossed back over the green line. The ADX is declining and below 20. It's also below the moving average. So we're in a trendless environment, just like the daily chart, and we're negative, just like the daily chart. The Arun is showing that buyers are decreasing as sellers are also decreasing. So this is still positive overall. On the daily chart, this is extreme negative. So we're not seeing a lot of confirmation yet in this chart. The mass index is not producing a signal. Looking at some charts, here is the daily chart showing broke down below support on an increase in volume. This is a longer term look at that same chart, showing how we might have done some damage technically. A lot of support levels and trend lines that were holding up the market have now seemed to be giving way. Our trend channel shows us dropping down below the midpoint of the trend, going back to 2009. We're also below the monthly pivot now, so that's turned things more negative. We're below the 50-period moving average now, which equates to the 200-day moving average, so that's more negative. The long-term trend, we were getting close to a golden cross here, but now we've dropped back down and looking more negative. The bullish percent index has dropped below 50 and is declining, and we're seeing a very similar pattern on the daily chart. Chaikin oscillator still above zero, but it is declining overall, where it's more negative on the daily chart. The Chaikin money flow starting to roll over a little bit, where we've gone negative on the daily chart. The force index has turned negative, and that confirms what we're seeing on the daily chart. McClellan oscillator getting extreme negative, also the same as the daily chart. The summation index based on price is declining and below zero, as well as with volume. Our oscillators are kind of just jumping all over the place. We're turning a lot more negative on the daily chart, where we have turned back down with the slope. We're just crossing over with the TSI. The MACD is just about ready to roll over, as is the PMO and PPO, where the TRIX and the KST, our longer term oscillators, are still showing that we're in an uptrend, where we've switched more to across the board negative on the daily chart. Swellen trading oscillator based on price and volume are below zero and declining, and not necessarily extreme. The PMO continues to rise, as we just saw, but based on price and volume, we are declining. The PMOs that are rising, starting to get extreme negative. The number of buy signals also is extreme negative, and we're declining with those that are above zero. And we're seeing a very similar thing here. What we can be watching for is a deeply oversold condition, both on the daily charts and on the weekly charts at the same time, and we hit support, and the market is able to bounce up off of that. Now, things could switch a lot more negative if we have that condition develop. We hit support and then just keep going down after that. So that'll be very telling as to what's happening. Then looking at the RSI, we're below 50 and declining. That's negative. The special K is still positive overall, above the moving average. The Stochk RSI is extreme negative. The Williams percent R is continuing to decline, but it's not extreme currently. The Vortex has switched over to negative. The red line has crossed above the green line. The Ultimate Oscillator below 50 and declining. Money flow indicator below 50 and declining. The percent B, it's just showing that we're below this dashed line and declining, so that's negative. The rate of change going back 1 week did show a real drop and not necessarily extreme. Going back 50 weeks, we're starting to see some weakness. The Kopit curve is not giving us a signal currently. And the weekly chart showing that we're coming back down to this 38.2% retracement, going back from the COVID low to the all-time high. That's at the 38.12 level. So if we continue to fall, we'll be watching that very closely. Also, there's a moving average at 37.26 that we'll also be keeping an eye on. Our different charts are looking more negative. The Heikin Ashi has black candles. The Kegi is still black overall. That's positive. It hasn't switched to red yet. The Renko is also still positive with an open block. The equi-volume chart is showing how we're below zero and declining. When we look at the ease of movement indicator, we added a new zero with the point and figure, but there's no signal that has been generated. The three-line break still hanging in there with open bars. But our Elder Impulse system is now switched to negative with a red bar. Parabolic SAR. We're finally seeing some confirmation here. We switched negative after Thursday with the dot on top. Well, we're seeing a confirmation of that in the weekly chart. So now we have the daily and weekly charts confirming each other. Looking at the broad market, here's the S&P going down, where the mid caps really took it on the chin, as did small caps overall. All stocks, after giving us a recent golden cross, is now showing a lot of weakness. And that's going to be a real theme that you see here in a lot of different markets. A recent golden cross, but just about the time we generate that is when some real price action comes in the opposite direction. The mid caps, recent golden cross, weakness. Small caps, recent golden cross, weakness. The Dow, recent golden cross, weakness. The Nasdaq never did give us a golden cross and had been holding up a little bit better. We're right down here at the 13-week moving average. We're a little bit below that, but can the Nasdaq find some support? Nasdaq 100 also showing some weakness. And the Wilshire never did give us a golden cross, also showing some weakness. NYSE, recent golden cross, weakness. FANG stocks, getting kind of close to a golden cross. We did see one on the daily chart. It was being hoped that we might see one on the weekly chart, but also showing some recent weakness. ARK just got decimated again this past week. Wasn't even close to a golden cross and down almost 11% for the week. Looking at the biggest software companies, didn't get to a golden cross, but did see some weakness. Here's a look at the banking index. This is BKX in a weekly chart, how it had been in an overall uptrend, but starting to show some weakness, and we were getting close to a death cross. Then you can see just how quickly things just went down. We're negative with the RSI and not necessarily extreme. We're also crossing over negative with the MACD on the bottom. Looking at Dow theory, just showing not really all that much other than utilities were going down more than the trannies and the Dow recently. Looking at the broad market, the CRB index gave us a recent death cross and is still declining. Copper still kind of hanging in there. It has been dropping a little bit, but it's in an overall uptrend. Gold, which seems to be one of the areas that folks are getting into, it ended up being pretty strong on Thursday and Friday. After giving us the golden cross, it has been falling back, and now it could be starting to gain some more upside momentum. And the same thing with silver. Still not a really good looking chart here, and it was still down on the week. But these are areas that folks like to get into when there's insanity starting to develop. Oil still hanging around between the $75 and $80 a barrel. The dollar, which had enjoyed a really good up week in the previous week, well, last week it has seen some declines. Looking at bonds, where bonds are going up now. On the daily chart, we do have a recent golden cross. Here, we don't have one yet, but we're seeing some improvement with the total bond ETF. And this is a daily chart showing how interest rates had been really going back up. And then late in the week, they really started to go down as folks were getting into bonds from stocks. Here's the MOVE index, which is the VIX for bonds, showing how bond volatility has been picking up. Here's a weekly chart showing how the US, the UK, and Germany, the rates had been going up, but we're starting to see them come down slightly with the US and UK. They're still tending to go higher in Germany, and Japan is kind of its own little story right now, but we're keeping an eye on that. Looking at relative studies, here's intermarket analysis showing how oil has been still doing the best, going back to the beginning of 2022, followed by the dollar. Gold is ticking up slightly, where stocks and bonds continue to be negative. And then looking at bonds versus stocks, showing how bonds continue to underperform, but we're seeing a little spike up here that could breathe some life into bonds. Stock to bond ratio, which is still in an overall uptrend, but has been falling back as we're seeing this flight to quality. Gold to the US dollar, how gold has been going back up, so it's outperforming the dollar, but it's still chopping around overall. And gold to the S&P really is outperforming right now. Gold is still in an overall uptrend and is outperforming the S&P 500. And low volatility, still in an overall uptrend, but showing some recent weakness. Growth to value shows how growth has been really underperforming, but we're seeing a little bit of a tick up. But it's going to have to do a lot more than what we've seen in the past few days to switch this ratio to be more in growth's favor. Looking at the NASDAQ 100 against the S&P 500, where the NASDAQ 100 is actually held up better. They're more growth stocks, and they held up better, where the S&P is growth and value together. So it's not surprising that the NDX has outperformed recently, but it's still in an overall downtrend. Where the 100 stocks that make up the S&P 100 are still underperforming the S&P 500, but showing some recent improvement. And discretionary against staples, still in an overall downtrend with discretionary. Energy to tech shows that energy's really been going up, even though it's showing some recent weakness against the tech sector. Looking at some trends, this is something that's more deeply in the background. When you go to the October low and we hit an extreme negative reading with our NYSE breadth thrust, which is the same that happened in 1987, 1990, 1998, 2008, and coming up out of that, looking out 1, 2, and 3 years, it has a perfect track record. It doesn't necessarily mean that the market's going to go straight up. We had been showing some real improvement coming up out of this, but now we're starting to fall back. This is a section that I just started including a week ago. This looks at the weekly chart of the S&P 500 and compares momentum. What's actually happening? Well, when you go back to 1998 to 2004, it looked like we were breaking out of this downward sloping trend line. The only problem is, if you look at the MACD on the bottom, it wasn't really improving all that much. When we say it's really improving, that means it's breaking above zero, and that just wasn't happening. And then after that, you saw real weakness coming into the market. Then projected ahead a little bit, it looked like we had broke above this downward sloping trend line, but even though the MACD was improving, it had not been able to get above zero. Okay, now let's look at 2007 through 2010. Looked like we broke above this downward sloping trend line, but the MACD was pretty much flat, and then we saw real weakness after that. Now let's look at this today. A week ago, this was looking a lot better. Now we're starting to see some danger signs. And I've been updating this every day in the daily videos that I do, where it looked like we broke above this downward sloping trend line, and the MACD was doing better and actually crossed above zero. But now we're starting to roll over as we're seeing some weakness. If we roll over, that means that this potentially could be a fake out instead of a breakout, and that could really take things a lot lower, because there's some pretty hefty support in here, and if the market continues to be below that, that could really shift things a lot more negative. On the positive side, this hasn't crossed over negative yet, and we might see a bounce and this bar start to show some improvement, and that could turn the MACD back up and still have it advancing above zero. So we're a bit unsure as to what's happening right now. We're just watching it on a daily basis. So what's our outlook for the upcoming week? On Tuesday, we have the NFIB Small Business Optimism Index, which will be coming out. The big one's going to be CPI. Then on Wednesday, we have the Mortgage Applications Index, the Empire State Manufacturing, Retail Sales, and PPI. Another big day with data. Then we'll also have business inventories and the NAHB Housing Market Index. On Thursday, we'll have weekly jobless claims, the housing starts, as well as building permits, which can be a leading indicator, the Philadelphia Fed Index, and then import and export prices. On Friday, we'll get industrial production and capacity utilization, as well as consumer sentiment and the leading economic index. So what we're watching for, the technicals, they're shifting more negative, and sentiment has really shifted over negative. Can we find some support somewhere and then bounce up off of that because of this inflation and interest rate scenario? And we're going to get a slug of information that the market will be able to react to. I've also added one thing over here, banking contagion. Is that a one-off type of banking situation, or is this going to bleed through and become a lot bigger situation? We just have one Fed speech coming up this week, and it would be kind of nice to attend that since it's in Hawaii. Nothing like suffering and listening to very exciting economic theory, but being on a beach at the same time. Looking at the Stock Traders Almanac for Monday, I'm not going to go through all of this. I'm just going to focus on Monday's session. The Dow is neutral to positive, being up 57.1% of the time going back to March 2001. The S&P and the NASDAQ are up 2/3 of the time, so they're looking more positive. And then the other things that you can pause and look at, and I addressed this in other videos as well, we do have some positive backdrops here that could be really giving some support to the market, but we're just seeing a real negative period right now, trying to decipher, is everything shifting to more negative, or is this just a little bounce lower before we get set to go back up higher? Looking at trading day number 9, which will be Monday's session, we do have a tendency to be more positive when it's in a pre-election year, and that's what we have. We're into this pre-election period, which is the gray area, which tends to be historically positive after we've had a bear market when the midterm elections took place. And then we are supposedly in this sweet spot for the S&P 500, but we're just not seeing that right now. But that could change. Look at how quickly things changed this past week. Things could easily change back more positive in the upcoming week or turn even more negative. I posted this a week ago. This is just a look from earningsbeat.com. Says the month of March tends to be slightly bullish. The areas that are hot are utilities, and it's kind of interesting. The area that is not hot are financials, and that includes the banks. We've passed through the March 1 through 5th area, and we're now getting into this second area, the 6th through the 9th. Now we're coming into the third part here, where that tends to be more positive. After we finish this area, we tend to be flat to slightly down for the rest of the month of March. So our scenarios, not really going with the down one right now. Even though our technicals are negative, we're getting rather extreme oversold in the short and intermediate term based on the day charts. Can't go with the up one because everything's pointing down right now. So we're still going with this sideways pattern. And the ADX is strengthening because it's starting to turn back up on the daily chart. Hasn't turned up yet on the weekly chart, but it's below 20 and the red line's on top, so we are negative. Thank you. Hope you found this helpful. I will also be preparing the intermarket analysis video as well as the deep dive video and the supplemental video. So have a great weekend, and I will talk to you in the next video.